The global economy is currently resting on a level of debt that has no historical precedent, creating a fragile foundation beneath the modern financial system. Governments, corporations, and households have collectively borrowed far more than global productivity growth can realistically sustain over the long term. What makes this situation uniquely dangerous is not only the sheer size of global debt, but the rapid shift from ultra-cheap money to persistently higher interest rates. For more than a decade, low interest rates masked structural weaknesses and encouraged borrowing without immediate consequences. That illusion of stability has now begun to fade. Central banks raised interest rates to combat inflation, and debt instantly transformed from a manageable tool into a systemic pressure point. The United States alone carries government debt exceeding $30 trillion, a figure that now influences global market psychology. European economies face mounting fiscal strain as higher borrowing costs collide with aging populations and slower growth. Japan's debt burden surpasses its annual economic output, testing the limits of long-term financial sustainability. Emerging markets face even greater vulnerability because much of their debt is denominated in foreign currencies. When global interest rates rise, capital flows towards safety, leaving weaker economies exposed. Debt servicing costs now consume an increasing share of government budgets across the world. This leaves fewer resources available for infrastructure, innovation, healthcare, and social stability. To compensate, governments borrow even more, reinforcing a self-perpetuating cycle. Investors have begun to question whether this debt can ever be fully repaid without severe consequences. The global financial system ultimately depends on confidence, and confidence erodes faster than balance sheets. Once trust weakens, markets react immediately and often violently. Bond markets are already signaling stress through rising yields and declining prices. Rising yields reflect growing concern about risk rather than optimism about growth. Higher yields make refinancing existing debt significantly more expensive. Financial institutions holding large amounts of government bonds feel this pressure directly on their balance sheets. Banks, pension funds, and insurance companies rely on sovereign bonds as foundational assets. When bond values fall, financial stability weakens across the entire system. Weak balance sheets reduce lending capacity. Reduced lending slows economic activity. Slower growth makes debt even harder to sustain. At this stage, debt stops functioning as a growth mechanism and becomes a systemic threat. Central banks face a nearly impossible dilemma. Keeping interest rates high risks triggering financial instability. Cutting rates too early risks reigniting inflation. Inflation acts as a hidden tax that quietly erodes purchasing power. Governments have historically relied on inflation to reduce the real value of debt. However, inflation destabilizes societies and undermines trust in institutions. History shows that prolonged periods of excessive debt rarely end smoothly. Some countries default openly. Others default indirectly through currency depreciation or persistent inflation. Currency weakness increases import costs and fuels further inflation. Rising living costs intensify social pressure. Economic stress often precedes political instability. Global debt is no longer a collection of national problems, but a deeply interconnected risk. Financial markets are linked through banks, funds, derivatives, and trade relationships. Stress in one major economy can rapidly spread across borders. The 2008 financial crisis demonstrated how quickly contagion can move. Today, global debt levels are significantly higher than they were before 2008. This makes the system more fragile, not more resilient. Technology accelerates both market growth and market panic. Information spreads instantly, and reactions are amplified by algorithms. Automated trading systems intensify volatility during periods of uncertainty. When investors rush towards safety simultaneously, liquidity evaporates. Markets freeze when everyone attempts to exit at once. Governments promise stability, but their tools are limited. Fiscal stimulus requires additional borrowing. Monetary easing risks renewed inflation. Financial repression harms savers and long-term capital formation. There is no painless solution to excessive debt. This is why debt is described as a time bomb rather than a simple problem. The exact moment of crisis is unknown, but the pressure continues to build. Global demographic trends intensify the challenge. Aging populations increase pension and healthcare costs. Fewer workers are supporting more retirees. Productivity growth has slowed in many advanced economies. Slower growth reduces the capacity to service debt. Climate transition investments add another layer of financial demand. Rising geopolitical tensions increase defense spending. All of these pressures compete for limited public resources. Some economists believe sustained inflation will be used as a long-term escape route. Others warn that future debt restructurings are inevitable. Financial markets are already pricing higher risk into sovereign debt. This challenges the long-held assumption that government bonds are risk-free. If sovereign debt loses its safe status, the entire financial architecture changes. Banks, funds, and central banks would be forced to rethink asset allocation strategies. Capital may increasingly shift toward real assets and alternative stores of value. Gold historically performs well during periods of debt stress and currency uncertainty. Energy and raw materials gain strategic importance. Countries with strong balance sheets gain geopolitical leverage. Economies with weak finances face painful trade-offs. Debt can restrict sovereignty as effectively as military defeat. Financial dependence reshapes political decisions. The global debt era is entering its most dangerous phase. The next crisis may not arrive suddenly. It may unfold slowly, eroding confidence over time. Gradual instability is harder to recognize than sudden collapse. By the time risks become obvious, options may be limited. Debt rarely destroys systems overnight. It weakens them incrementally. Trust erodes before numbers fail. Confidence disappears before defaults occur. Financial crises begin psychologically before they appear statistically. The real question is not whether the system will change. The real question is how that change will be managed and who will bear the cost. History suggests that ordinary citizens often absorb the burden. Savings lose value. Taxes increase. Public services decline. Financial awareness becomes a survival skill. Understanding debt dynamics is no longer optional. The global economy is approaching a defining moment. Decisions made today will shape the next generation. Debt helped build the modern world. That same debt may now determine its most severe test.